and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is one of the amazing ways to exit highly appreciated assets, defer tax, so you can create and preserve more wealth or help your clients, friends, and family do the same. Hey, I'm your host today, Brett Swarts, and each guest we bring on the show, we try to bring on some of the best real estate, financial wealth, and business minds in the world. So together we make complex tax deferral strategies simple and passive income plans achievable. Hey, I'm excited about our next guest. We're shooting here live in Sacramento, California. He's a friend. He's a long-term commercial real estate multifamily expert. He's the head of acquisitions at Sequoia Equities and has been a part of over $2 billion in acquisitions and underwriting and deals. In fact, they're one of the biggest owners in all of Northern California. And also multiple states. Please welcome to the show with me, Erik Peterson. Erik, how are you doing today?
Doing great. Thanks for inviting me to be present.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Absolutely. I've been associated with Sequoia Equities for almost 22 years now. We have under management about 16,000 units, about $5.5 billion in AUM. I've been associated with, as you mentioned, almost $2 billion in acquisitions with the company. The company now has around 450 employees, and we've just continued to grow via acquisitions, via third-party management, and continue to provide a quality service to all those associated.
Excellent. You know, and Erik, I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. So I'm curious, go back to the younger days. What would you say those one or two gifts you believe you were given, and how does that help, how you help and bless people today?
Yeah, thanks. I've been very fortunate to have a great upbringing. Had the benefit of resilience. I think I've been given that great gift that I can then empower and encourage others through my own challenges in life to then have the understanding to be able to help those who might be going through a difficult moment, whether professionally, personally, or otherwise, and be able to hopefully lend that hand out.
Absolutely. Resilience is so important. And talking about focusing on multifamily investments right now, kind of the changing market where we're shooting this video. It's near the end of October, and things have changed drastically in the past 4 to 6 months. And so, what would you say the number one secret is to underwriting multifamily properties in today's market? And what kind of resilience do people need to be practicing to make sure they're not catching a falling knife?
Absolutely, great question. I think that's a question that so many economists, so many acquisition teams are going through. Rates right now are trying to understand where their values lie. So I do believe that prudent underwriting will dictate really the future IRR that we see on assets. So, having a really conservative exit cap rate, having conservative rent growth going forward, understanding controllable and non-controllable expenses much better. It's going to come over the next 2 years will come down to those groups that can have the experience in management and can adjust accordingly on their expenses and teams, and then really drive that customer service from an asset perspective. So I think those will be major indicators of who's successful and who's not.
I'm seeing the larger deals especially, right? And this has always kind of been true. And I call it the Amazon effect. Those that are vertically integrated with management, with local, contract services that go deep, relationships, of course with the broker relationships and, finding deals, underwriting deals, and really performance. But it seems like those that have, more units in a particular marketplace, they're more likely to be able to pay maybe a little bit more and or to be able to sustain changes that are going on, or at least do it in a more efficient way. So just talk about, Sequoia Equities and, guys, I think it's over 17,000 units, and how much that helps you guys to be able to weather the storms and buy deals and find deals and make them work.
Absolutely. Longevity in a marketplace is very important. Understanding the nuances associated in a changing market is very important. Economies of scale from a management perspective is very important. Having a team in place that has been, let's, for lack of a better term, they're very stable. They're very happy. We do annual corporate birthdays. So we just had somebody had 35 years with Sequoia Equities. So to say that longevity within a company is important at Sequoia from a cultural perspective, it's very important. And we find that happy employees tend to provide happy housing, happy tenants, customer service to tenants who are then happy. which then trickles down to the ability to have lower turnover. And then we have those savings and costs at the end of the day that just translates to great operating profit to the investors.
Absolutely. And that also probably means you can underwrite deals and you're understanding the deals and all the nuances because you have the data. It's direct data, right, in those markets. So what markets are you guys focused on now? Maybe talk about a recent acquisition or a deal that you're looking at now. What do you like about it? And maybe how has your underwriting even shifted, as far as an exit cap rate perspective? What kind of interest rates are you seeing on some of these quotes? And are you still buying?
Yeah, absolutely. Great question. So, we follow a lot of market dynamics. We use third-party sources. There's Reese, Yardi Matrix, Axiometrics, Moody's, et cetera, that compiles data. And we track that data to identify key markets that have great employment trends, that have great low new development trends. So we're not competing against high absorption markets. And we try to follow net migration in various markets. So as we look at those, we're hot on Denver. We're showing Seattle MSA is strong right now from a jobs perspective. We see that there are some pockets in the Midwest and the Sun Belts that are very strong, and we're continuing to also focus on areas where we already have management, but for picking off deals where there's significant value add that can occur in some of those markets too.
What do you feel like the one thing people are either overlooking or maybe over-exaggerating, right? Like, what's the thing you say, it's maybe not that bad on this thing, and I think this is a reason why we can still get value there, right? Give me the kind of the positive and the negative, the ones that are like, well, that is really serious. If that factor's in place, and it could be rent control. I mean, it could be just secondary markets where lenders aren't necessarily going to be lending on. What is that, maybe that positive, negative that you want to make sure you clarify when you're buying deals today?
Yeah, I mean, the political aspect it can be challenging for sure. We see certain counties in California still struggling with rent collections and COVID relief associated. That doesn't necessarily scare us as we have a very good handle on those markets and currently manage quite a few assets in those markets today. But the other is really trying to find markets where the lender is loaning at the highest LTV and debt service coverage. So that's finding areas where we're getting the best benefit from a Fannie, Freddie, or a private lender perspective or insurance lender. So that we can drive IRR returns to our investors by prudently leveraging and putting the right debt on the right acquisition on the right asset.
Excellent. And Sequoia Equities, their success, right? They're top of what they do, and they've been doing it for so many years. And you talked about culture, you talked about leadership, you talked about longevity, and maybe just the focus on the fundamentals. But what's maybe the one thing that maybe someone doesn't know about Sequoia that you've seen from the inside? You say, that's also a part of the secret of success.
Yeah, absolutely. We have the company culture and then our customer service are two real major prongs that differentiate us. It's been proven that the right type of marketing that can be done that is a little outside the box. I highly suggest that people Google some of our Sequoia Equities marketing. You'll, for one, see that we have a fun culture, and two, the jovial attitude that can exude from a fund marketing program. Our trainings. Sequoia does extensive training. As you can understand, we're selling a product, and that product is an apartment. And so this is a pretty big monthly expense for many households. On the order of 30% of their or more of their income goes towards rent. So you have to provide value for that. So our leasing staff has to be well trained to be able to manage through the expectations and be able to serve that clients' and customers' needs.
Amazing. I love that. And it makes sense, right? Everything rises and falls on leadership and culture. And so the ability and of course service as well. So the ability you can have all of those working together hand in hand, you're going to thrive as a business. So I think exactly right what you're saying. That seems like what Sequoia has been doing, and it's why they continue to be successful. I want to shift gears a little bit. I want to talk for the investor, right? It pertains to capital gains tax and the ability to use cost segregation to offset cap gains tax, or if they're a real estate professional, and also just 1031 exchanges in general. So I'm curious, Erik, what would you say is one of the best things that Sequoia does in regards to making tax efficient choices and strategies for their investors? Maybe talk about cost seg real quick.
Yeah, tax deferral is a really important strategy within Sequoia Equities for all investors. So we do a cost segregation analysis that allows us to take a 27.5-year straight line depreciation schedule and cram that down into about a 7-year forward depreciation amount. That on top of this year with the bonus depreciation can add significant amounts. And that bonus depreciation, as you know, is phasing out over the next 5 years. This year we still have 100% bonus. Next year it's 80, 20% less each year for the next 5 years. So in general, we try to get anywhere from 35 cents to 45 cents of every dollar passed through in year one depreciation. And that's what is pretty standard and typical. So depending on your tax characteristics, and please talk to an accountant, but you can then potentially take a significant amount of that to offset other earnings or other passive gains in other areas.
Excellent. And then when you go to exit, 10 times or maybe all the time, you're typically trying to do a 1031 exchange. But maybe talk about the times when you're not going to do the 1031 exchange and why.
Yeah, absolutely. So we really push for 1031 exchanges, but as you're very well aware, they are challenging, and there are instances where they can break. But we are very fortunate to have a large stable of great brokers, worked with you in the past on deals, and that share us great opportunities. So we have a great pipeline when it comes down time to do that 1031. We often start 6 months ahead of an expected exit date. That gives us plenty of runway to make that efficient exchange.
Excellent. And by the way, for those that are listening, if you do run out of time for your 1031 exchange, is a unique strategy called a Deferred Sales Trust, not to be confused with the Delaware statutory trust that allows you to defer the tax even out of LP positions or GP positions. It also works for crypto, primary homes, business sales. It can also go back into investments with folks that are doing, Reg D or doing different type of syndication models, which is really unique without having to be a tenant in common or do it through the 1031 model. So talk about the value of something like a Deferred Sales Trust as it pertains to people that want to exit, defer the tax, and be able to diversify back into multifamily syndication.
Yeah, so we do Regulation D offerings, standard syndication model. It's 506B or C, developed really during the Jobs Act. And that has really opened up the general solicitation and arm's reach solicitation to accredited investors. That allows us to then take parties that are in the Deferred Sales Trust and accept that type of capital, which for many owners who are tired of fixing toilets and dealing with tenants, allows the passive opportunity for them to be a participatory on an institutional class asset.
Right, without also having to put all of their eggs in one deal or do a tenant in common or 1031 into the deal. It can be smaller amounts. And so that's one of the flexibilities. By the way, if you want to learn more about that, you can go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. That being said, Erik, we're running out of time. You ready for the lightning round?
Hit me.
All right, if you can go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
Oh, man. Don't be so hard on yourself.
Excellent. Number two question. What's the number one book you've recommended or gifted the most in the past year?
Turning Point is a really good, a great book that I've been reading lately.
Excellent. Number three question. What are you most curious about right now?
How to encourage others continually with a positive atmosphere and create a really great atmosphere of leadership for all employees and colleagues.
Excellent. Number four question. What's your number one leadership quote or theme that you strive to live by?
Do unto others as you have them do unto you.
Excellent. And last question, Erik. After all your success, helping all the people you've helped, building all the wealth you've built, how do you stay centered in your values, and how do you stay encouraged to charge forward to reach new heights?
Great one. I think that's a really hard one, because balance is what I aim to do, to be able to hit that. But as type A individuals, we always work a lot more than we desire, maybe. So always on, maybe backing down a little bit here and there, but just better balance.
Excellent. Erik, I want to thank you for being on the show, and I want to thank you for spending some time with me. For our listeners who want to get in touch with you, what's the best place for them to find you?
Absolutely. You can reach me at epeterson@sequoiaequities.com. You can also find us on the web at sequoiaequities.com or experiencesequoia.com. And look forward to connecting with anyone on questions and to be a resource for everyone from property management to investing at any time.
Thanks, Erik, for being on the show. And I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust and or connecting with someone like Erik who can help you invest into multifamily syndication deals is an amazing way to grow wealth. to get tax efficiency with cost segs. So you want to take a peek at that. And again, you can connect with us at capitalgainstaxresearch.com. Please rate, review, subscribe. Please share this so it can inspire today.